everyone, it's Natasha, and right behind me, I think you can see here, is Stamford Bridge Football Ground, which is the home of Chelsea Football Club here in West London. And right behind me over here is a little pub where the football club was formed in 1905. And I was just thinking how Chelsea Football Club is a really excellent example of how you need to look at least two sets of financial information to understand the business and how it makes money and how it continues to trade. So when I work with people who are starting to learn about financials, I always encourage them to look at an organisation's profit and loss and their balance sheet. And if we use Chelsea Football Club as an example, you'll see that if you look at their profit and loss, it has all their revenue coming into the business. So for instance, for Chelsea, it will be ticket sales from the stadium here. They have a 41,000 capacity here. They also have a massive shop here for merchandise. They have sponsorship deals. They're part of the Premiership League here in the UK, so they have broadcasting deals as well. And you'll see all of this income coming through in their profit and loss account, and then you'll see all of the expenditure against that. One of the major ones being how much they spend on their team, but also how much it costs to keep this stadium running and all the support staff who work here. And a profit and loss will give you a profit or a loss number for a 12-month period, traditionally a 12-month period. And for Chelsea, you'll see that over the last 20 years, they haven't always made a profit. They've made losses, sometimes substantial losses, and then even when they have made a profit, they haven't always made a large profit. So if you were to just look at the profit and loss for Chelsea Football Club, you wouldn't really gauge that Chelsea Football Club is an internationally recognisable brand and that it has some value, and if it were to be sold, it would probably be sold for a lot of money. So to gauge that, you would have to go over to the balance sheet. And the balance sheet really shows the assets of the company, which are things that are of value for the company, and it shows an accumulation of those assets from the time that the business started. So it's not just 12 months, it's an accumulation from the very first day. And that's offset by the liabilities of the company. So that's the risks associated with this organisation. And that really allows you to start gauging the value of this company as opposed to the profit or loss of the company. And on the balance sheet, you'll see that Chelsea is funded by their owner, who has invested over £1 billion in the organisation. And then therefore you'll understand how Chelsea can continue to trade even though it's made losses, sometimes on consecutive years. So I thought this is a really good example to just introduce the concept of a profit and loss account and a balance sheet account, and how you need to look at the two, understand the two, and how one would affect the other. And I hope it's been of some value to you just hearing this. I think it's a really good start point if ever you want to start looking at an organisation, be it the one you work for or one you want to invest in, or an organisation you want to work for in the future. And if you have any questions around profit and loss, balance sheets, or just where to get started in your financial education, then just drop me a line and I'll be happy to answer your questions. Thanks.